Hey investors, welcome to this episode of InvestU. Today we're going to be doing a deep dive into some S&P 500 index funds that are traded as ETFs. So I've listed some companies here that trade S&P 500 index funds under ETFs. Vanguard's known for their VOO, perhaps Spider or State Street Global Advisors for SPY, which is one of the longest traded ETFs that's out on the market these days. And if you're like me, perhaps you listened to the Berkshire Hathaway annual meeting recently and listened to Warren Buffett promote S&P 500 index funds and why you should invest in them and why he's going to have his family members invest in them after he dies. And really got me thinking as to whether or not I should have this or a larger position of a index fund as part of my overall portfolio. As a stock picker, I do like to have individual stocks, and I have found some good value stocks recently, especially with the downturn of the market. But it does bring up a good point that perhaps we should consider having these in our overall portfolio to manage risk and benefit from the growth of the overall American economy, and really at this point benefit from some of the lows that we've had as a result of coronavirus. So why would we consider investing in an index fund? The statement really, I think, sums this up as if you can't beat them, why not join them? So Warren Buffett has had a famous bet with a number of hedge funds. I think this lasted over a series of 5 years, where he bet them that they couldn't consistently beat the market. And when we say the market, generally we're referring to the S&P 500 index. And what he found was that none of the hedge funds that he bet with could beat the market consistently year over year. He has had a pretty good record of beating the market on many years himself, but this is something that's very challenging to do, especially when you get into some areas where there is quantitative easing going on in the market. The U.S. government is injecting capital, and generally when that happens, it finds its way into the stock market and can inflate funds. So we want to take advantage of that if we can, and a great way to do that is through an S&P 500 index fund, where you're really purchasing the whole market, or roughly 80% of the overall market cap of the American Stock Exchange. This is a great method for balancing risks in your portfolio. So as mentioned, it's a very large fund. There's many companies in here. So as some companies may drop and are impacted by downturns in the market, such as coronavirus, others will seek to benefit from it too. So over time, you see a smoothing of ups and downs. And overall, we see steady growth year over year for many, many years in the S&P 500. Another big benefit of index funds is because they're really passive in general, there's not a lot of active trading going on. Really, there's a set number of companies here. There's about 505 companies in the S&P 500. There may be some changes over time as market cap increases and decreases. But generally, there's not a lot of trading required for an index fund to start here. So as a result, there are some ridiculously low fees. We'll get into that for some of the ETFs, but they are fractions of a percentage point that we're looking at for fees on an annual basis, which over the long run can really, really add up to a huge difference in our overall nest egg. So another benefit of exchange-traded funds and index funds is you get to invest in some top stocks for a minimal investment. So we could buy a VOO ETF for about $200 and some odd dollars at this point in time, and that will allow us to invest in companies like Google or Alphabet, which trades upwards of about $1,400. Facebook and Apple, which are around the $300 mark. So really you can buy quite a few really good stocks and really good companies through this index fund, and it is quite low cost to do so. As mentioned, the S&P 500 tracks 505 of the largest cap stocks in the market, making up over 80% of the market. And I heard something funny, a funny phrase, which is the Ron Popeil method of investing, which is set it and forget it. So maybe you remember watching Ron Popeil on some infomercials growing up. He had that chicken rotisserie where you could put in the chicken, it would cook the chicken, you set the time and forget it. The same thing is true for an S&P 500 index fund. You buy it, you leave it alone, you watch it grow over time, and this is something you can regularly purchase. So if the market's down, great, you can buy more shares of these index funds. funds. If the market's up, well, then you're taking advantage of some gains in your overall portfolio for your purchases of S&P 500 index funds. So this is definitely a type of stock that I would look at purchasing regularly and not touching at all, as it is a strong component of your portfolio. So why an ETF and why not a mutual fund? I think a lot of us have been historically aware that mutual funds are kind of an easy way to get into an index fund, and I think the important thing between these two, especially if you have a 401k or perhaps in Canada you have an RRSP where your company contributes to a fund and you're allowed to allocate it as you wish. There's maybe a slight difference between the fees between an ETF and a mutual fund when it comes to an index fund for the S&P 500. But really what we're looking for here is a low-cost option of getting into the market, and something that's not really needed to be actively managed and have a large number of trades, which results in fees to the customer at the end of the day. I think either way, through an ETF or a mutual fund, we are going to have low fees. There may be some advantages to an ETF versus a mutual fund. For example, there can be tax benefits for an ETF. So mutual funds, as they get traded, there are capital gains that the fund experiences, and those capital gains get passed on from the fund to the investors to pay out. So there are some advantages with an ETF there. Another advantage with the ETF is they are ridiculously easy to trade. So if you see something bad coming out in the market and you want to get out of your position, or you want to get into a different position, you can sell the ETF on a dime, really, and get out of it at 1 hour and into it the next hour. Versus mutual funds, you're going to have to phone the bank or your investor. You're going to have to ask them to sell your fund. There may be some fees associated with that, depending on how long you've held the fund. And they will have to make that transaction on behalf of you, which may take a few days to have happen. So mutual funds traditionally have had higher fees than ETFs, and you can read up on this on the web. There's a lot of articles about why ETFs may be a better investment fund. Mutual funds are typically actively managed, and as a result of that, they have higher annual fees. So you're paying for somebody to manage these funds. There's trades going on your behalf, and that all leads to fees for the investors. There can be early exit fees, which prevent people from going in and out of funds, and same with sales fees. It can be expensive to purchase them, and perhaps your sales fees get waived if you've carried this fund in your portfolio over a number of months or years. And then the other challenge, too, is there are minimum balance requirements for a lot of mutual funds. So they may require you to invest $3,000 or $5,000 initially to get in, and then you can purchase mutual funds after that on a regular basis. Whereas for an ETF, really the minimum balance requirements is the cost of the share plus the fees of buying the shares over time. So what are we looking for in an index ETF? So a couple things that I would be focused in on before I buy an ETF, especially an index-based ETF, is the fees. So how does that compare to others that are in this marketplace? In this case, because it's an index that tracks the S&P 500, I want to understand how well does it actually track the index. So in order to do this, we would be doing correlation calculations on a regular basis between the index itself and the ETF. So if it tracks it quite well and has a good correlation of close to 1 or 100%, then I know that it is representative of the overall S&P 500. I want to look at past performance of the fund. How well is it done year over year, and especially how well is it done year over year relative to other index ETFs. I want to see what the dividend yield is. Perhaps one thing that could be attractive too, especially if you're not an active investor and you don't want to be dealing with this on a quarterly basis, is a dividend that gets reinvested or even a dividend yield in itself. How does that compare with its peers? So the size of the fund, assets under management or market cap is important. And the reason why it's important is I would like to pick a fund that has a fairly large volume of trades. If it is a larger fund, that means that there's going to be other sellers and buyers out there. So if I want to offload this fund, it's not going to be all that challenging to do. So I want to look for something with a larger assets under management or market cap. And then I also want to look at the volatility of the fund. So we're going to be digging into the beta of some of these and making sure if it really matches up to that index. Okay, so I've done an analysis over a period of 5 years for 5 funds here. So the first one is ticker VOO, and that's the Vanguard S&P 500 ETF. The next one is one of the longest ones that's been out on the market from an ETF perspective, which is SPY, and that is the State Street S&P 500 ETF. Next ticker is IVV, which is the iShares or BlackRock S&P 500 ETF. Next one is SCHX, which is the Schwab US Large Cap ETF. And lastly, PPLC, which is a smaller index fund, which is a Portfolio Plus S&P 500 ETF. So let's dig into these funds to see how they perform and stack up against each other. So you can see from a fees perspective that they are really, really low fees. I would say that from an overall perspective, a 0.03% fee is really quite good. Not that a 0.09% fee really is all that much more. It was really a negligible difference over 5 years in terms of the fund performance and the fees. But with a 0.03% fee compared to something like a 1% fee that maybe you would have for a mutual fund for like a large cap type fund, you are going to see a substantial difference in the final value of your portfolio. I've done some quick calculations just over a 25-year period, and when you compare a 1% fee versus a 0.03% fee, it basically results in a 14% difference in your overall value at the end, just in fees alone. So when we're digging into this, I'd say VOO is probably the best from a fee perspective here, though Charles Schwab is matching that, and PPLC is really quite close. From an inception perspective, so SPY, as mentioned, has been around the longest, followed by IVV, and then the Charles Schwab, and then Vanguard and PPLC. All of these are quite stable. They do have a fairly large asset under management with the exception of PPLC. So they are funds that are traded on a regular basis. So I'm not really worried that any of these funds in particular are not going to have enough volume to accomplish the trades that I want. So under this example, I've taken a $10,000 investment and looked at it over a 5-year period in terms of what would I have. And at the end of the day, all of them come out relatively the same. I will say the PPLC gives a slight advantage, but then there is a little bit more of a volatility there when you look at the beta. It's a 1.32 compared to a 1.0 for the rest. And it doesn't track the index as well, and we'll get into that from a correlation perspective. So if I was looking strictly at the returns and I wanted something that exactly matched the S&P 500 or very closely matched it, I would be looking at the Vanguard fund, the VOO, just because it does have the highest return relative to the correlation to the market. So when I'm looking at the average return, as mentioned, PPLC is on top with a 9.61% return, followed by the Vanguard fund, VOO, at 8.94%. And you can see the rest there in terms of the returns. From a dividend yield perspective, this is factored into that overall 5-year return. I did not reinvest the dividends when I was looking at that. I just assumed it was paid out and captured as an overall percentage there. So it was not reinvested into the fund. And even though it does have the lowest dividend yield at 1.98%, it did perform close to the top at a 5-year rate there. So if you are looking for more of a dividend return, I would suggest, again, the PPLC fund. You need to consider the tax implications of this because this would get paid out and you would be paying capital gains tax, but it is a nice 3.72% dividend on an annual basis. So from a correlation perspective, VOO, SPY, and IVV virtually track the S&P 500. It's almost at 100%. Some slight dips for the Charles Schwab and the PPLC, which again result in slightly higher beta there. But at the end of the day, they're almost all tracking the S&P 500. From a market cap perspective, VOO is definitely on top, so that would have the most assets under management. It also has the most volume that's coming out on a regular basis, so there's a lot of trades that are happening for this fund. So I would recommend that one from a high volume point of view. Followed by SPY, IVV, the Charles Schwab, and the PPLC. And then from a beta perspective, as mentioned, the only one that's not beta of 1 is PPLC, which is a little bit more at 1.32, and that has resulted in some higher returns. But all we need to be aware of is that it does have a little bit more volatility than the market. So typically how beta is measured is it's a comparison against the market or the S&P 500. So we should really see a beta of 1 for all of these funds if it's tracking the market appropriately. So with all these index funds, really what we want to look into is, do fees really matter? So what I've done here is I've taken an ETF at 0.03% versus a mutual fund at 1%. And I've just pulled 1% out just because I found some large cap mutual funds and they were around 1%, some slightly higher, some slightly lower. And what I've done is I took a $10,000 investment over a 25-year time span and growing it at around 9% per year, which is similar with the funds that we looked at on the previous slide. And in the end result, over a 25-year period, the ETF is worth $17,000 more than the mutual fund, just with that slight fee increment. So it's definitely something we want to keep in mind for our portfolio. So in continuing this theme, say we're regular investors, we put in $10,000 per year. How is that going to match up from a fee perspective as I buy ETFs or I buy mutual funds on a regular basis? Again, I'm assuming it's $10,000 every year for 25 years with a 9% return. And when I'm looking at my retirement savings after a 25-year span, the ETF is going to be worth $129,000 more, or 14% more than the mutual fund investment would be. Now, if I look at this relative to a more expensive mutual fund, some fees are upwards of 3% to 5%. For more actively managed funds. And this may have a variety of investments, stocks, bonds in those funds. Maybe it's a growth type fund. And if I invest $10,000 every year for over 25 years with a 9% annual return, I would see a difference of $337,000 or 36% more for the ETF. So that's definitely something to keep in mind when you're looking at fees. And really, I think it's been quite proven that it's very tough to beat the market. There's many books that are written on these topics. Tony Robbins has a great book that he released recently that I'll paste in the show notes. It's a very good introductory book that talks about investing and why you want to get into index funds if you're going to buy mutual funds or ETFs to get into the market, and really how it substantially impacts your overall portfolio over time. So definitely something to keep in mind as we are investing, that those funds or those fees over time can really eat at your overall nest egg. So getting back to the summary of funds, all of these funds really perform quite well. If I had to pick a fund today to invest in, I would invest in VOO strictly because it does track the market, and that's what I'm looking for. It does have the best return, and it does have the lowest fees amongst the 5 ETFs that I've been taking a look at today. But really, if you own any of these funds, I would stick with them. I don't think there's any reason to switch or sell and pay the fees to switch to anyone else, unless maybe you have a really, really large position and you want to consider doing that for some marginal gains over time. But all of these are really good at tracking the S&P 500 and will provide you with really good annual returns over the long run. One last important thing to keep in mind is with the fees, for those of us who are just starting out with ETFs, when we see these fees, we don't actually have to pay for them and have money in our account. These fees are paid for over time. So when you see a 0.03% fee, you don't have to calculate that based on your balance. So say you have $10,000 in your account, nobody's going to be taking that withdrawal out of your account per se. This automatically gets deducted from the fund over time. So you won't see this fee specifically, and that's done consistently throughout the year and factored into the stock price as you go through it. Thanks for checking out this episode of Invest You. Don't forget to click subscribe below and visit us at valueinvestu.com for more videos and information.